Hi, Barbara Freeberg here, former university investments instructor and investment portfolio manager, here to talk to you again about lazy investing and how you can have $787,355 at age 66 through lazy investing. And why do we talk about it, lazy investing? Because we have a lot to do. And for most of us, investing is not our number one priority. But if you could set up your investing, put it on autopilot, and end up with $787,000 at age 66, wouldn't you like to do that? Question mark. Well, it's not a million, okay, and if you want to reach a million, well, you'll have to save and invest a little more, but this is doable, and it is better than the median saving and investing midpoint of those in that age range. So from age 65 to 74, the median amount saved is $426,000, according to Vanguard's How America Saves report from 2023. So if you want to almost double that amount, let's talk about where to begin. Trying to consistently pick investments that are going to beat their benchmarks. And a benchmark is like the S&P 500 or the total stock market, which is a proxy for the overall US stock market, is like trying to win a marathon wearing muddy boots. There's a lot of drag, your odds of winning are very low, and the high costs associated with attempting to beat the market will almost guarantee sluggish results. And this quote is from my friend Richard Barry, all about asset allocation, one of his books. So who doesn't want to amass money for retirement? Even if you're in your 20s and you're living the high life, you realize that at some point you are not going to be in your 20s and you're going to be in your 60s or your 50s, and you're going to want to take it a little easier. And we're here to talk about how to do that today, step by step. Now, this article is for you if you don't want a lot of muss and fuss in your investing approach. You want a good market matching investment results. And that might sound like an oxymoron, but market matching results are quite good and actually beat the results of active investors 70-80% of the time. And even if an active investor or actively managed mutual fund beats the market returns one year, they're very unlikely to do that again. So let's scoot down here and look at market returns, and you'll get a sense of what I mean. Here's a picture of market returns from 1973 through 2022. And the US stock market annualized. That means taking the average of returns and allocating them annually, returned 10.24% per year. That sounds really good, right? But you also have to understand the trade-off for these 10.24% returns is that you're going to have to accept some down years where the stock market might have declined 10, 20, 30, 40%. And so that's the trade-off to get these very nice high returns. Now, if you're interested in investing in bonds, and they should be a part of every portfolio, albeit even a small percentage for those of you who are younger, then from 1973 to 2022, the 10-year Treasury bond, which we're using as a proxy for overall bonds in general, returned an average of 6.12%. And cash type investments earned roughly 2% per year. Clearly, you might say, why not invest all in the stock market? You can get rich quicker, faster. And some people do that. But those are the folks that can say, if the stock market drops 40 or 30% in a year, they can say, okay, I'm not selling now. I am going to invest more now, and I can handle this, and I will not sell at the bottom. Because if you sell at the bottom or after a drop, you don't know when to get back in, and you have to be right twice. You have to be right about when to sell, and then you have to be right about when to buy back in. Now, just a little more data that you can look at on your own. 73 to 2000, wow, unbelievable results. But stocks got super overvalued. Bonds did. Cash was through the roof due to some inflationary factors and high interest rates during this period. These type of returns are unlikely to repeat. From 2000 to 2022, the stock market returned only 6.20%. And that's because after the run-up in stock prices that burst at the end of last decade and continued to fall in 2001, 2002, 2003, led to a lower average stock market return, albeit better than those of bonds and cash. That was a lot. So the takeaway is stock market returns in the past have offered very nice average annual performance. You don't need to do anything fancy to garner these long-term returns. So what's the lazy way to invest and to amass our $787,000 at age 66 without doing a lot of work? The smartest and easiest way to begin is through, wait for it, automated investing. Automated investing is so super easy because you set up your investing plan once, and then you might have to rebalance periodically, but you don't have to actively manage your investments on a regular basis. So you might automatically invest into your workplace 401k plan. And in many cases, your employer will match part of your contribution. The monies you invest will compound and grow over time. You set an asset allocation or mix between stocks and bonds that works for you. And it is likely that when you retire, you will have a very tidy 6 to 7 figure nest egg. What if you don't have a 401k? You can set up a Roth IRA, or if you're self-employed, you can set up a simple IRA, a SEP IRA, and automatically transfer directly from your paycheck or bank account into the investment or retirement account. This ensures that your financial future is secure, of course, unless you subsequently withdraw the money, which I don't advise. And funny thing is, if you don't see the money in your checking or savings account, you'll learn to live on less and you won't spend it. And you can be confident that it is growing for your retirement and other goals that are more than 10 years away. This simple automation strategy eliminates the need for a lot of budgeting because you know that your retirement planning is taken care of. Okay, so how much should I invest? We're assuming an expected rate of return of 7%. That's not guaranteed. Your return might be higher, it might be lower. But if you have an asset allocation or investment mix of 70% stocks, 30% bonds, 60% stocks, 40% bonds, 80% stocks, 20% bonds, something like that, this is a reasonable minimum expected rate of return over decades. Not over 1 year, not over 5 years, but over decades. So if you start at age 25, which is a great time to start investing, you know how much you have to invest per month? $296 in order to reach your $787,000 goal at age 66. That is not a lot to swing for almost anyone. If you wait till you're 30, you're going to have to invest $427 a month. If you're 40 and you want this amount at age 66, you're going to have to invest nearly $1,000 a month. If you're 50, you're going to have to invest over $2,000 a month. The takeaway, start early. Okay, so here's just a little picture of a calculator I used, and you can use this too to find out. It's called an S&P 500 Dividends Reinvested Price Calculator. That's a long word for figuring out how the S&P 500 stock market proxy has performed over any amount of years that you would like to investigate. I put this in to check out the 10-year average annual returns between 2013 and October 2023 and got a 9.633% return with dividends invested. You'll get different amounts depending on the dates that you put in. I got this from DQYDJ.com, Don't Quit Your Day Job, who has amazing calculators. But if you're lazy, you don't want to do the work yourself, I also want to recommend one of my fave calculators, which is the Empower calculator. It's very sophisticated. You can put in a lot of different scenarios, what if situations. You can either link your accounts or you can manually input them if you don't want to. And also, it is free. So you can use the Empower free retirement calculator to do some really good retirement planning. I will put a link below. And actually, if you do click on that link, our company might get a small commission. You don't have to use that link, but again, I suggest using this free calculator to help with your retirement planner. And it also does some investment analysis, budgeting, and offers a lot of other investment reports. Okay, so the next question is, well, if you agree with me, which, I don't know if you do or you don't, but pretty much the majority of what I'm saying does have some Vanguard research to support it, some other data to support that investing in a balanced market matching funds over the long term does deliver pretty good results. Now, we don't know the future. Nobody does. But if you look at the past 100, 150 years, and you assume that world and U.S. companies are going to continue to grow, then you can expect some positive returns. We're going to wrap it up by talking about what percentage should I invest in. And this is going to be called your asset allocation or your mix between stocks and bonds. Now, bonds typically, although they have done terribly in terms of return, really for the past 10 plus years, that is not their historical performance. And you have gotten an average of 5% returns by investing in bonds, and they are less aggressive. So in other words, although they will fall in value, they typically do not decline in value as much as stocks. And in many cases, they will offset losses in the stock market by delivering positive returns when stocks fall, or if not positive, then less drastic negative returns than stocks do. So the question is asset allocation. So here's where we're going to talk about the types of funds you can use to invest in to get your lazy portfolio. The Vanguard, and these are examples, there are many of these types of market matching index funds that you can find online, and I'll put some links below as well. For example, the Vanguard Total World Stock Market Index Fund, which in the mutual fund you can find here, or the ETF is VT, the symbol. That covers companies within the entire world. It's one fund that is so diversified that you don't need any other stock funds. You've got international and U.S. companies within that fund. And then you can put your bond portion of your portfolio in a general bond index fund, and then you are covered. Or if you want to just break it up a little, go for a Standard & Poor's S&P 500 stock fund like SPY, and then you can add in an allocation to international stocks as well. Bond funds, super easy. There's many diversified bond funds. You can expect an average over the long haul of 4 or 5% if you invest in bond funds. These are the returns since 1955. They range from a low of practically zero from 2010 to 2015 to a high in the early 80s of over 17%. And where can you get a diversified bond ETF, exchange traded fund? Well, AGG is one, BND is another. These are the ticker symbols, and you can mix that in. But if you want more samples of various asset allocations, I will put links to videos and other resources which give you ideas on how to create your asset allocation. So here's the guarantee. There is no guarantee in investing, as is there is no guarantee in life. But if you start investing regularly now, you do have the potential to amass a 6 or even 7-figure retirement portfolio. And if you're not keen on investing on your own, I have developed a partnership with WiserAdvisor. And if you click on this link here, this picture, and I'm going to put a link to the article as well, you get 3 vetted fee-only financial planners that you can speak with. So if you would like to learn how to invest the lazy investing way, read the article and some of the other resources I'll put on below. Sign up for my channel, subscribe, and I will see you next time. Thanks so much for watching. Bye.